Welcome back, Eric. Good to see you. What's new in your world?
I'm probably feeling more positive than I have for a while, which may seem ironic to some of your viewers, but I'm actually feeling positive because I'm fairly sure New York's going into a bear market, which is something I've been waiting for a while.
Why is that?
I came to the uncomfortable conclusion a year or two ago that it was probably going to take some kind of a reset in the general market to really get any attention back on this space. Unfortunately, the process that's generating that bear market, which really started with China and with oil, isn't doing a lot of good for base metals, unfortunately. I'm not expecting 2008, but I think like a 20 or 30% off the top for the S&P is, I think, pretty realistic right now. It may not be an official recession in the US, but I think we're going to get something that'll feel like it. You're just now starting to see a bit of money flow back into gold, even though the US dollar index doesn't come off that much. I think it may come off more. I'm not crazy about trying to sort of promote gold as being the anti-dollar, but whether I want it to be or not, it is. There's two things really holding the dollar index up, and one is the assumption that the Fed is going to raise rates faster than I think that it will. The other thing is the assumption that there's going to be a fairly large differential in the growth rates between the US and the two other major currency pairs, the Eurozone and Japan. If I'm right about what happens with the US economy, there isn't actually going to be that much of a differential. So it would be quite reasonable to expect the US dollar to start coming off. Plus it's an extremely crowded trade. Everybody and their dog is along the dollar. I think that combination gives us room for a decent move in the gold price in the next few months. I know most of the chart guys, and I'm not one, say there's one more leg down, it's got to go to 900, 850, whatever it is. I was sort of in that camp as well until things really started rolling over in the fall. I'm not convinced we do need to see another lower leg. I think the lows we saw in December, that might have been it.
It'll be interesting to see how the gold price reacts if there's disappointment in the federal government.
They're not going to do anything with the rate, but they might sound a little more hesitant. But I saw a couple of interviews with two Fed governors last week, and both of them made the comment that based on what's happened in the oil market, it could be that we were a little too optimistic about how fast the inflation rate was going to come up. And I was just shaking my head reading this stuff, going like, you've got to be effing kidding me. You guys were expecting a move on inflation based on what was happening with oil in the last year. I get the sense they're going to back off. I'm not a big believer that we're going to see like QE4 or anything like that. It's possible. I don't think it would help that much.
You've also got China showing up with softer numbers. That should put a damper on the global economy.
There's a school of thought, especially in the US, that nothing outside of the US matters, but on a global basis, China accounted for more than half the growth rate between 2001 and 2014. There's no way that's not going to impact everybody else if they really slow down. I think I would agree with virtually everyone that it's more than the official number. They're not growing at 7. I don't know how slow it is now. They really need 3 or 4% just to kind of stand still. I'm not necessarily thinking they're going to go negative or anything. In the commodity space, we have to recognize the fact that they're putting a lot of effort into shifting to services. Last year was the first year where services represented 50% of the economy. That's a good thing, and that's a shift that has to happen. But of course, that slows down the growth rate for basically all commodities in terms of usage.
Yes, but you still have to provide infrastructure in China and elsewhere.
I think they're still serious about trying to complete the urbanization process. They seem very serious about this Silk Road initiative, and that's a massive, massive initiative. And building that out is going to involve, a hell of a lot of commodities. It's just the growth rate will be a little slower, so what we'll see, I think, over the next year, 18 months, and it's going to vary from metal to metal, but it's going to be what we've all seen before.
Commodity pricing, is it market fundamentals or is it technical now?
It's a bit of both. I'm actually just in the middle of doing a sort of early year double issue where I'm going through each metal individually. The December imports of wrought and unwrought copper was the second highest ever in December. But you'd never know that if you looked at a copper chart. You would assume looking at a copper chart that warehouse inventories have gone through the roof. They're going down. And I'm not trying to belittle the impact of the problems in China, but there's definitely a lot of sentiment here. The technical traders, the hedge fund guys, everything's following oil around. Oil's like this mother duck, and all the other commodities are just kind of going around behind it.
Thanks for taking the time for today's interview, Eric. Where can people learn more from you?
If if you drop into hraadvisory.com, the stuff on the metals is going to be it's an editorial. So at some point after it's gone to subscribers, we'll bundle it up and send it out to anybody that's added themselves to the free list.